There are many different ways to classify stocks. For example, stocks can be classified by the size of companies that issue them, by the industries they are in, by how volatile the stock prices are, and many other classifications. In this video, I will describe 6 common stock classifications. 1. Blue chip stocks. 2. Growth stocks. 3. Income stocks. 4. Value stocks. 5. Cyclical stocks. And 6. Interest rate sensitive stocks. Blue chip stocks are high-quality stocks of big profitable companies that have paid dividends over many years. They are generally some of the safer stocks in the market due to the fact that their prices don't swing as wildly as those of other stocks. Some examples of blue chip stocks are IBM, Coca-Cola, Microsoft, American Express, McDonald's, and Boeing. Growth stocks are stocks of companies that are growing their share prices, net earnings, or cash flow at faster rates than the market at large. Growth stocks are very often smaller, newer companies or industry disruptors. Whatever their size or age, growth companies are most likely to be found in the technology sector or among companies that offer innovative products that puts them ahead of other companies in the same industry. Companies with profit growth of over 20% per year usually have growth stocks. However, because many growth companies may not make any profit in the early stage of existence, you will have to look at their stock price growth as an indication of whether they are considered growth companies or not. Growth stocks usually don't pay much in dividends, if they pay dividends at all. Growth companies normally just put a lot of money back into research and development instead of paying dividends. Income stocks are stocks of stable companies that pay large dividends. Dividends, of course, represent the profit companies pay out to stockholders. Retired people who want steady income often buy these types of stocks. Income stocks normally show some modest growth in dividends over time. Stocks of electric utility or communication companies are typically considered income stocks. One income stock you may recognize is Verizon Communications. Verizon currently pays dividends of about 6.5% of its stock price per share. This might not sound like much, but Apple currently pays only about 0.5% of its share price in dividends. Value stocks have a low price-earnings ratio, meaning they are cheaper to buy than stocks with a higher price-earnings ratio. The price-to-earnings ratio is the ratio of the price per share of a company's stock to its earnings per share, or EPS. For more information on the price-earnings ratio calculation, see our video, Price-Earnings Ratio. Value stocks may be growth or income stocks, and their low price-earnings ratio may reflect the fact that they have fallen out of favor with investors for some reason. People buy value stocks in the hope that the market has overreacted and that the stock's price will rebound. Cyclical stocks move up or down with the general economy. In a rising stock market, these stocks generally move up in price, and in a falling stock market, they generally move down in price. Many cyclical companies use heavy equipment and industrial materials for their products. Examples include companies in the paper, steel, chemicals, railroads, auto, and airline industries. Interest rate-sensitive stocks are affected mostly by changes in interest rates. Banks are considered interest rate-sensitive businesses because they feel the effects of rising interest rates. For example, high interest rates mean that people will borrow less from banks.